All right, think about planning a big trip. Maybe that dream vacation you've always wanted. You'd map everything out, right? Flights, budget, where you're staying, maybe even learn a few key phrases. You plan. Now, if a simple vacation needs that kind of planning, just imagine what goes into auditing a huge company. Millions, maybe billions on the line. So today, we're doing a deep dive into something absolutely fundamental, audit planning. Why is it so incredibly crucial? And, maybe more interestingly, what are those hidden factors, those risks that auditors are constantly juggling behind the scenes? And this isn't just, best practice. The AICPA, the main body for auditors, flat out says an audit must be planned. That word must tells you everything about how basic this is. But before we really get into the weeds of audit planning, just a quick but important reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we'll be discussing, it's all derived from the fantastic accounting resources over at farhatlectures.com.
So whether you're an accounting student trying to get your head around this, a CPA candidate grinding away, or even a seasoned professional, definitely check out the website. They've got loads of extra practice questions, video lectures, and really detailed support to help cement what we talk about today. A big thank you to Professor Farhat for making this valuable material available.
Okay, so back to it. An audit must be planned, not optional. Why? Why is the AICPA so firm on this? Our sources point to basically three core reasons, kind of like pillars holding it all up. One, making sure you get enough of the right kind of evidence. Two, keeping audit costs under control. And three, avoiding major misunderstandings with the client. Let's start with that first one, getting sufficient appropriate evidence. What does that really mean in practice for an auditor?
Well, what's fascinating and maybe not obvious is that auditors don't check every single thing. I mean, they can't. It'd be impossible. We rely on sampling. And the quality of that sampling process is absolutely critical. Planning is how we guide that sampling. It's the map. It ensures we collect enough appropriate evidence to really knock down the audit risk. That's the risk we might get the opinion wrong. And just as importantly, it reduces the legal risk to the audit firm itself. It's about protecting the firm's reputation, upholding that public trust. Good planning helps us figure out, okay, which areas need a deeper look? Where are the potential problems? Focusing our effort there really helps limit our liability down the road.
Right, so it's about being precise, targeted, and managing risk on the evidence front. Makes sense. But you mentioned cost control. That's where it gets really interesting from a business perspective, doesn't it? It's not just about doing a thorough job, but doing it well, efficiently. How does good planning help an audit firm manage its resources and stay competitive?
Oh, absolutely. Think about it. An audit firm runs like any business. Resources aren't infinite. You've got limited time, limited staff hours, a limited budget for each engagement. Planning is essentially the strategic allocation of those scarce resources. It's the blueprint. It lets us channel our efforts, our best people, towards the areas we identify as high risk. We use things like analytical procedures early on during planning to kind of sniff out where those potential trouble spots might be. And yet, in the CPA world, it's incredibly competitive. Being efficient, keeping costs reasonable through smart planning. That's not just nice to have, it's crucial for survival for winning bids.
Okay, so planning is definitely good for the auditor, good for the firm's efficiency and bottom line. But what about the other side of the equation, the client relationship? We always hear how important client satisfaction is. How does solid upfront planning help avoid friction or misunderstandings with the company being audited?
It really boils down to communication and managing expectations, setting them realistically from the get-go. Just imagine you tell a client, yep, we'll have this audit wrapped up by June 30th. But then, because maybe you didn't plan properly, underestimated the complexity, didn't assign enough staff, whatever, you suddenly have to say, actually, it's going to be more like the end of August. That's a recipe for an unhappy client. Could even be a breach of contract situation, depending on their needs. So proper planning means those deadlines are actually achievable. It means you coordinate properly with the client for things they need to help with, like, say, being ready for an inventory count or making staff available for interviews. It just prevents those nasty surprises and builds trust, avoids those messy, sometimes costly disputes that pop up when expectations aren't met.
Yeah, that makes total sense. It's becoming really clear that auditing isn't just, ticking boxes and crunching numbers. It seems deeply fundamentally tied to understanding and managing risk. And when we talk audit planning, our sources say it really revolves around assessing three key types of risk. These are acceptable audit risk, client business risk, and the big one, the risk of material misstatement. And a lot of that initial planning phase is basically gathering information to get a handle on these three.
Exactly. Let's start with acceptable audit risk, or AAR. If you think about the big picture, AAR is quite literally the level of risk the auditor is willing to accept that the financial statements might still be materially misstated even after they've done all their work and issued a clean, unqualified opinion. It's the chance you're willing to take that you might be wrong. The source material uses a pretty powerful analogy. Think of a doctor misdiagnosing you. You actually have cancer, but they tell you you're perfectly healthy. That's the kind of potential impact we're talking about, though obviously in a financial context. So auditors actually set this level. Maybe it's a 5% risk they're willing to live with, or 10%, or maybe even 15% in some cases. And here's the crucial part. A lower AAR, say, wanting only a 5% chance of being wrong means the auditor needs more assurance. And getting more assurance directly translates to doing more work, more evidence, more time, more resources, probably more senior staff involved. Aiming for 0 AAR, well, that's just not practical. That would mean looking at absolutely everything, no sampling allowed, not feasible in the real world.
Wow, okay. So AKR is really about the auditor's own judgment call, their risk tolerance, how much uncertainty they can live with. But then there's the company itself. What about the risks they bring to the table, the inherent vulnerabilities or external pressures they face? How does that factor into the auditor's planning?
Right, that brings us to the second type, client business risk. Now, this isn't directly about errors in the accounting records per se. It's more about the risk that the client organization itself might fail to achieve its own objectives or execute its strategies successfully. These risks often come from factors kind of outside the auditor's direct control, but they can have a huge impact on the company's financial health and therefore on the financial statements we're looking at. We're talking about things like major shifts in their industry, a traditional retailer struggling to adapt to online competition. That's a business risk. Or maybe changes in regulations that suddenly hit their operations hard. Even just the company setting bad goals or having flawed strategies can create this risk. A classic example is an economic downturn that tanks their sales and makes it hard for them to collect cash from customers. That's a significant client business risk. So if we assess that the client's business risk is high, it's a signal to the auditor. Pay closer attention. These underlying struggles can easily bubble up as misstatements in the financials.
Okay, that makes sense. It's about the context the company operates in. Which leads us to the third one, which sounds like it gets right to the heart of potential errors, the risk of material misstatement, or RMM. What exactly is that and how does it work?
Yes, RMM, risk of material misstatement. This is the risk that a significant error or fraud actually exists in the financial statements before we even start our detailed audit procedures, though we do consider the effectiveness of their internal controls when assessing it. It's often thought of almost like a formula. RMM is the product of two other risks multiplied together. It equals inherent risk, IR, times control risk, CR. Let's break those down. First, inherent risk, IR. This is the susceptibility of a particular account balance or a whole class of transactions to being materially misstated, assuming there were no related internal controls. It's the risk that's kind of just baked into the nature of that account or even the industry the company is in. Think about auditing, say, petty cash versus auditing complex derivative instruments.
Big difference.
Huge difference. Counting cash or basic supplies. Pretty straightforward, low inherent risk. But valuing those derivatives, that involves complex calculations, a lot of estimation, maybe relying on subjective data sources. That's high inherent risk. Or think about valuing intangible assets that don't have a definite lifespan that requires estimating future cash flows, which is inherently tricky. Complex executive compensation plans can be risky. Even whole industries like oil and gas, where you're estimating reserves still in the ground, that's inherently risky. And importantly, this inherent risk gets amplified if the client doesn't have strong internal controls in place to mitigate it. Which brings us neatly to the second part of RMM control risk, or CR. This is the risk that the client's own internal controls the systems and procedures they have in place to safeguard their assets and ensure accurate reporting might fail to prevent or detect and correct material misstatements on a timely basis. You can think of internal controls as the company's own defense system for its accounting information. If those defenses are weak, either badly designed or just not working effectively, then our assessment of control risk goes up. We can't rely on their systems to catch the problems.
Okay, so we have AR, the auditor's tolerance for error. We have client business risk of the company's own operational risks. And we have RMM, broken down into inherent risk, the riskiness of the account itself, and control risk the client's own checks fail. Phew, that's a lot of risk. So what does this all actually mean for the audit itself? How does assessing these different risks shape what the auditors do when they show up at the client's office?
Well, this assessment phase, understanding these risks, it's absolutely foundational. It dictates the entire audit strategy. Evaluating AAR, client business risk, and RMM directly determines several key things. First, what specific audit procedures we need to perform. Are we doing basic checks or much more rigorous testing? Second, how much evidence we need to gather. Higher risk means we need more persuasive evidence. And third, even who we send to do the work. Do we need senior, experienced staff on this, maybe specialists like valuation experts or IT auditors? Or can junior staff handle certain lower risk areas? So for instance, going back to that inventory example, if we identify a high risk of material misstatement in how inventory is valued, maybe because it involves complex estimates and we know their controls around it are weak, then we're definitely going to plan to gather way more evidence for inventory. We'll perform more extensive tests like detailed price testing or observing the physical count very closely. And yes, we'll assign experienced staff, maybe even someone who specializes in that industry, to really scrutinize that account. The assessed risks literally sculpt the audit plan and resources deployed.
That really connects the dots. Let's try to solidify this with a practical example. Our sources at Farhat lectures often use multiple choice questions, which are great for testing understanding. Let's try one. Here's the question. Which of the following measures an auditor's willingness to accept that the financial statement may be materially misstated upon completing the audit and expressing an unqualified opinion? Again, and the options are A, control risk, B, sampling risk, C, inherent risk, or D, acceptable audit risk. What do you think?
Okay, let's walk through them. Option A, control risk. Is that the auditor's willingness? No. We just defined that, right? Control risk is about the client's internal controls potentially failing to catch misstatements. It's about their systems risk, not the auditor's acceptance level. So A is out. Option B, sampling risk. Well, sampling risk is the risk that the sample we choose isn't representative of the whole population. That affects our conclusions, sure, but it's a risk inherent in the process of sampling, not the auditor's overall tolerance for being wrong in their final opinion. So B isn't quite right either. Option C, inherent risk. Again, we talked about this. That's the riskiness of the account or transaction itself before controls, like derivatives being inherently risky. It's a component of RMM, but it doesn't measure the auditor's final judgment call or willingness to accept potential error in the opinion. So C is also incorrect.
Which leaves us, by process of elimination, with the answer D, acceptable audit risk. And that fits perfectly with how you described it earlier.
Exactly. Acceptable audit risk, AAR, is precisely that measure of the auditor's professional judgment about how much risk they are willing to take, that they issue that clean, unqualified opinion, but oops, there was actually a material misstatement they missed. And just to reiterate why this matters so much, if that happens, if they issue a clean opinion and it turns out to be wrong, well, the people relying on those financials, investors, banks, regulators, they might suffer losses, and they might very well come back to the auditor. That means potential lawsuits, damage to reputation. It's the ultimate professional stake in the ground.
So wrapping this up, it's clear that audit planning isn't just some bureaucratic exercise or a simple checklist. It's really a dynamic, deeply risk-informed, strategic process. It's absolutely essential for ensuring financial reports are reliable and ultimately for protecting both the audit firm and the wider public interest that relies on trustworthy financial information. You could say it's the bedrock upon which trustworthy audits are built.
Absolutely. And thinking about all this, it maybe raises an interesting question for you, our listeners. Now that you understand these different layers of risk, the auditor's own risk tolerance, AAR, the client's inherent business challenges, client business risk, and the potential for errors or weak controls within the company itself, RMM, how does that change the way you think about a clean audit opinion? What does knowing about these underlying risk assessments mean for you or for anyone who uses financial statements to make important decisions? Something to ponder.
Definitely food for thought. And if this deep dive into audit planning and risk has piqued your interest, or if you want to explore these concepts further, maybe look at specific accounting topics in more detail. Remember, there are comprehensive resources out there like the practice questions, video lectures, and detailed support we mentioned earlier from Farhat lectures that can really help reinforce and expand on what we discussed today. Well, that's all the time we have for this deep dive. Thanks so much for tuning in. We'll catch you next time.